This is InvestTalk. Independent thinking, shared success.
Hey, I have a question about company PVH. I have seen a significant sell-off over last few months, and there are some, I would say, bad news about it, but I was thinking right now it's a good time to buy. I just want to know your advice. Have a good day. Bye.
All right, looking at PVH Corp, it's about a $3 billion market cap, and they design and market brand apparel in more than 40 different countries. So you like that diversity, but these are mainly two designer brands. This is Calvin Klein and Tommy Hilfiger. Okay, and they generate practically all of its revenues. Now, these names aren't exactly, I think, in style right now. They have some staying power over the long term, but clearly their business prospects are dwindling. Earnings are supposed to go up 9% this year, but those estimates are coming down. And next year, earnings are supposed to fall 1%. Last quarter, revenue is down 5%. And earnings continue to go up, but you can't keep squeezing more profits out of less revenue. There's a finite life there, right? You can only cut so many costs, and it looks like that's what's happening here. Is they're struggling. Yeah, earnings are going up, but cash flows look to have peaked, and the market is pricing in that things are going to continue to get worse here. We know the consumer is struggling to a degree. And once again, these are names that are not very popular. They don't have good trends from a fashion standpoint. Now, this is also a company that has a lot of debt, about $2 billion in debt on a $3.7 billion market cap. That's another issue, is refinancing of that debt, being able to carry that debt, et cetera. Now, I think they can carry it for now, but obviously if earnings deteriorate, then this could be a big problem. The chart is bad. There's no way to look, no other way to say it. It went from 140 back in about a year ago, okay, April of last year, and now it's down to 66 and change at the close today. This looks headed at least for the mid 40s, where it bottomed back in middle of 2022. That would be good support, but until those trends in earnings turn around and consumer sentiment turns around and they repair their balance sheet, and that's what needs to happen here. They need to take that cash flow and they need to pay down debt instead of buying back shares. And they've been buying back shares, and that's been a good thing, but that's been the source, I think, of their profit growth here. Because, like I said, sales are in decline. And when you have declining sales and you have a decent amount of debt, that is a recipe for disaster. So it's an interesting name to see if it can find some stability in its sales and its profits. And if it does, then it might be cheap. It might be a good buy. But until then, I would continue to pass on PVH. Thanks for the call. Now, I hope you've been telling your friends and family that this podcast can be viewed in video form over on our YouTube channel. And we get questions submitted over there, and let's answer some of those right now, or at least one of them. JDude88 says, I have a strategy for my taxable account I was thinking about. I already maxed out retirement accounts, and I'm in my late 30s. I was thinking of investing into Vanguard sector ETF based on which one or two sectors are considered most undervalued by the Morningstar market value information. I would plan to rebalance when a sector gets considerably overvalued. What do you think of this strategy? And do you have any tips on how to execute it well if you think it's a good idea? First off, I don't think it's a good idea. Morningstar is one opinion. As I always say, you don't take one man's opinion or one research source's opinion. So that's number one. Number two, just because it's cheap doesn't mean that it is guaranteed to get expensive anytime soon. It could easily stay cheap for a long period of time. So value is, as I've said before, a terrible timing mechanism. Now, if you want to talk about something that's cheap sector or company, whatever, and it's starting to gain momentum, and the market's starting to recognize the value that it's undervalued, that's another story. That's part of kind of what we do for our clients on our more active strategies. So I wouldn't use that. I would, if you're looking for taxable money, we do run a, and you're looking for something very simple. We a custom index strategy that can create losses. That's something to think about. I would go in that direction, but this is a sector rotation strategy. It's overly simplistic, and it's not the way I would go.
Get ahead in your financial journey. Sign up for the KPP Premium Newsletter and receive tailored insights every week.
My name is Daryl. I'm calling from California. My question is about Netflix, and just wondering if it's a good time to buy. Again, that's Netflix, NFLX. Thank you very much. Bye-bye.
Well, I don't need to tell everybody what Netflix does, but the question is whether it's a time to buy. Depends what type of investor you are. If you are a momentum investor, then you might want to continue to ride the momentum. Now, there are some signs that the momentum is petering out, but that's just some signals, not necessarily something that you bet on. For example, the general trend is higher, and so momentum tells you ride the trend until that trend ends, and that trend has not ended yet. It's still, like I said, in an uptrend. Now, from a valuation perspective, it's egregiously overvalued, trading at 11 times sales. And the last time it traded these levels, it peaked out back in 2021 at about $670 per share. No, higher than that, $690 or so. Went as low as about $160. So as I've always said with these momentum names, these speculative names, these growth names, when times are good, they boom and there's money flowing into them. This is obviously a popular name and things look great until that momentum ends. And then most of the people that are buying this name are weak hands. And when the trend changes, they jump ship quick because they're on to the next sexy hot name that they heard about. And typically they fall 70, 80, sometimes 90%, depending on the quality of the business. This one, last down cycle and the growth names and bear market, this one down about 80%. Will that happen again? I wouldn't shock me. Right? We're trading around $1,000 per share. Could this head down to 200 again? Would not shock me, right? That would be, maybe it'll go to 300. Who knows? But clearly, this is a momentum name. This is not a value name. That's all you're betting on here. So if you're a trader, a momentum trader, sure, go for it. But I am starting to see some signs that this momentum is peaking out. It's threatening a head and shoulders top. You're seeing weekly deceleration in things like MACD, and that is showing to me that the momentum is petering out. So no, I would not buy Netflix. In fact, it's actually a decent short, I think, at these levels over the medium term. Now let's quickly head over to a listener question from our InvestTalk YouTube channel. And Bail On Demand says, please give me your thoughts on 3M. I have owned this stock since February 2023. It's now up almost 80%. I'm wondering if it will continue to rise, or should I take some profits and trim my position? Well, I don't know the weighting of your portfolio, how much industrial exposure you have. Obviously, this is an industrial name, and how much exposure you have just to 3M. So I can't tell you whether you should trim based on that. If that's over 5% of your portfolio, you should probably think about trimming. I will say that. But this is now trading at about a market multiple, 21 times earnings. Earnings expectations, though, for this year and next year are being upgraded by analysts. So we always like to see those trends. Are they being downgraded or upgraded? And this one's being upgraded, so that's nice there. You are seeing, however, last quarter revenues were flat, earnings were down 1%. But once again, that does look like it's set to accelerate into this year. So that's a positive here. Now on the chart, let me go pull up a chart of 3M. Am I seeing any momentum? A little bit of signs momentum could be waning, but not a whole lot, to be honest with you. This just looks like it's stair-stepping higher, been consolidating since, what is this? mid-January, kind of hanging around this 150 range. Now we're at 153, spot 50 at the close today. I have no problem with it. I don't think it's overvalued at these levels in any material way. It's probably more fairly valued, if I would to be frank. It doesn't have much debt, only about $5 billion in net debt, $600 million in free cash flow. So, that's not a great free cash flow yield. So that's probably the one thing that I would have against it, but it is very profitable. And so I would, if it's over 5% of your portfolio, I would definitely trim. Otherwise, I would probably just hold on to it because the technicals are fine and the fundamentals look solid as well. Now, let's pivot over and talk a bit about debt and consumer debt mainly. And the fact that outside of the public market, right, the government, the private sector is deleveraging. And in a system of fractional reserve system, you need debt to kind of perpetually grow, whether that's on the corporate side, the consumer side, or the government side. It needs to go up. Otherwise, you have a deflationary shock like '08. That's what '08 was. It was this massive deflationary shock. And that's what the federal government was trying to do with COVID, which was counter this massively uncertain time with growth of government spending. And we know that the current administration is trying to reduce the amount of spending. Now, it's easier said than done. And ultimately, if they succeed, that will reduce the amount of borrowing growth. But if you strip out the growth of borrowing on the government side, the private sector debt load actually fell 2.4% as a percentage of GDP in the fourth quarter of last year. And that's the steepest deleveraging since the banking crisis of '08. Now, there were periods where you did get mild deleveraging since then, and that was mainly actually just during the 2023 regional banking crisis. And that was really tied just to the finance sector, right? Banks deleveraging. But so far, this deleveraging is actually household driven, as well as non-bank financials and state and local governments borrowing less. And that's the first time that all three segments reduced leverage in the same quarter. So this is the hard data that manifests when the consumer and businesses become more concerned about the future of the economy. Now, once again, this data is for the fourth quarter, but as you would imagine, it's not, at least so far, improving much in the first quarter due to tariff uncertainties, stock market volatility, etc. So this is something that will, if it persists, and you add on top government borrowing less, that will drive us into a recession. Absolutely. It will create a deflationary impulse. Now, do I believe that ultimately they'll allow that to persist? I mean, governments, will they allow the deleveraging like this to persist? No, because it would take down the whole system, because that, like I said, you need, in a fractional reserve banking system, you need debt to grow. And if it's not, the Congress or the White House, it's the Fed, right? Fed to step in and they will ease monetary conditions. And I think this is an example of something that tells you that, hey, the Fed will that's why they're winding down QT. They're already starting that. And that is much bigger of a factor than lowering interest rates. What they do with their balance sheet, tens of billions of dollars a month, one way or the other, has a dramatic impact on reserves in the system, the amount of lending in the system, et cetera. And so the big question here is, what will the Fed do? Will they be more aggressive and winding down QT? Will they even do QE by year end? I think that's underappreciated as well. And I do think we get about 3 cuts by year end. So this is the hard data that the Fed is looking at and ultimately will push policy on that side.
It's Andrew calling from Utah. Just got a question actually about the yield curve. Keep hearing you guys talk about it, and it's something I've been kind of keeping an eye on as well. The 2-year is paying more than the 10. Why would anybody invest in the 10? Isn't the reason that the 10 is lower than the 2 is because more people are buying that, driving the prices down? So why wouldn't people just invest in the 2-year and get a better yield so they can have a better outlook on the future? It just doesn't really make a lot of sense to me. It seems like it wouldn't be inverted for as long as it is because people would just go to the 2-year and they would get a better yield. You guys could shed some light on that issue. I'd love to hear your answer. Thanks, guys.
Well, that's very simple. The Fed controls the short end. That's what they do with the Fed funds rate. They lower it and raise it. But they don't control the long end. Now, they can do some things, Treasury and, can do QE and they can influence the long end, but they more directly control the short end. And so what the 10-year is implying is that in the future, the Fed will be cutting the short end. And so when you're buying the 10-year, you're locking in a rate. It might be lower than the current Fed funds rate. Remember, you're getting that for, say, 10 years. Versus the current Fed funds rate can be cut, right? You buy, let's say, a 1-year bond, might yield for, say, 4.5% today. But in a year, if the Fed cuts rates to, say, 3, now you have to go reinvest that at 3. And you would have been better off buying that longer dated bond and locking in a higher rate because now you're getting that 4+% beyond just 1 year. So that's what the yield curve is signaling when there's an inverted yield curve. It's just signaling what the market thinks short-term rates will be consecutively, basically, into the future. Now, when the yield curve is naturally upwardly sloping, meaning it's higher out into the future, that is the market being more optimistic about, hey, yeah, Fed funds rate is here, and things are going to be hunky-dory in 1, 2, 3, 4 years, and they may even raise rates. Okay, so that's how the yield curve works and what signals it's giving, what the market signal gives to investors based on how the yield curve is sloping.
Hi, this is Adrian calling from Texas, and my question was about ticker symbol WOOF, WOOF. That's Petco. It's been really good at being bad. It's been going down, 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 down. And my question is, when, if ever, in the foreseeable near future, would be a good time to get in?
Looking at Petco Health and Wellness, WOOF is the symbol. Gotta love that. Now, the issue with this, really since it went public, let's go back. It did have a nice little run in it. Let me pull this back here. Yeah, actually, no, it hasn't. It's gone down ever since it went public. Went public back in 2021, around $26 per share. And it's really been in a downtrend ever since. And that's all because free cash flow has just struggled to go positive. Return on equity has been negative. And it does have a lot of debt on its balance sheet. It's trading at $2.47. So here's a lesson here. When a company is trading below $5, especially below, say, $3 per share, and it has a lot of debt in its balance sheet, that's the market telling you that this company is in a high risk of going bankrupt. So clearly, while the demand for pet products continues to be going up, and that the average consumer, they bought pets during the pandemic, and I do think there's some, as I said at the top of the show, some legs to that. But it's not just about those secular trends that can help a business or a sector. It's about executing on that effectively, efficiently, profitably. And ultimately, Petco just hasn't been able to do that. They've turned some profits here and there over the last 5-6 years or so, but profits went negative again, or expect to go negative this year. And their cash flow has been vacillating between mildly positive and mildly negative for 5+ years now, ever since they went public. And their debt has just continued to go higher. So that's the issue here. It's just not a name that I would touch. Maybe monitor, it can break out of this and find some level of profitability that's sustainable. But until then, I would just continue to pass on it. Now let's take a look at SNAP payments. This is something that is part of the attempt by the current administration to reduce spending overall. SNAP funding, it runs at about $94 billion per year. And there is some talk about not cutting it completely, but reducing it dramatically. And you're already starting to see the impact on companies like Kraft Heinz, General Mills, and Dollar General. Because these are the type of companies that will be hurt by less money in the pockets of lower income consumers. And there's already been a recent shift to private label brands, basically saying, I can't afford the name brand. I'm going to buy private label. And this has hurt companies like Kellanova, which is a spinoff of Kellogg. They make Pop-Tarts and mac and cheese. And they derive about 19 and 21% of their sales, respectively, between Pop-Tarts and mac and cheese from lower income consumers. Okay, so that's the issue, is that that's where a lot of their profits come from. And if they can't spend on those products, or they spend less money in their pocket to spend, they're going to find alternatives. Now, it's not just about total amount spent on the SNAP program, but it's about what type of products are eligible for SNAP, for food stamps. That's what SNAP is, food stamps. And there's talk, because of RFK, to reduce the type of products that are eligible to be bought with food stamps, including soda. Now, historically, this has been more of something that was on the left, right? That the Democrats were trying to do is limit, from a health perspective, what type of unhealthy foods these food stamps can pay for. And it's starting to become more of a consensus. And these are hurting companies like Pepsi, like Dollar General, even Walmart, who has a significant portion of their low-income consumers, as their clientele. And so, it's going to hurt less Target and Costco. Those tend to be higher end consumers. But, think of that when you're looking at your portfolio, the type of packaged food companies that are, I think, in some sort of secular decline, as well as a lot of these dollar stores and other type of retailers that cater to the low end consumer. So I think that's a trend that has some legs to it. Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And if you need help understanding your risk tolerance level and how that relates to your portfolio and your long-term financial goals, I encourage you to head over to our website and schedule a portfolio review with me. Independent thinking should success. This is InvestTalk. Good night.